Hello, my name is Tom, and this is everything you need to know about balance of payments for A-level economics. So, firstly, balance of payments is a record of all economic transactions between one country and the rest of the world over a year. Some people get confused thinking it's only X minus M, exports minus imports, but it does include other factors as well. Now, a current account or a trade deficit is when a country sends more money to sources abroad than it receives, and a current account or trade surplus is when a country receives more money from sources abroad than it sends. Now, the balance of payments is made up of two accounts. It's the current account and the financial plus capital account. The current account is made up of three things. Firstly, trades in goods and services, X minus M. Secondly, there's primary income, which is income from investment, so like profit, interest, and dividends. And finally, secondary income, which is transfer payments. Payments in which you don't get anything back. So this can be government aid and contribution to global institutions, such as the United Nations or EU. The financial plus capital account is made up of two things. So firstly, changes to reserves, like the gold reserve, and secondly, investment. So this can be FDI, portfolio investment, and loans. It is worth noting that rewards from investment would be on the current account, but that initial investment is on the financial and capital account. In theory, the sum of the current account and the financial and capital account should equal zero. However, this doesn't always happen because, number one, there's a time lag between the goods and services being received and the documents being filled out. Secondly, there's often mistakes being made in the documents. And thirdly, some goods coming into the country are illegal and therefore the documents just aren't filled out at all. Now let's talk about a trade deficit, which if you remember is when a country sends more money to sources abroad than it receives. So if this trade deficit is a result of exports minus imports being weaker, then this would result in lower AD and therefore lower GDP, which would decrease the domestic standard of living. Furthermore, a decrease in GDP leads to an increase in unemployment. Secondly, currency weakness. If the trade deficit is because of low demand for exports, then the demand for the pound falls, and this causes the pound to depreciate, leading to cost push inflation. And thirdly, borrowing from abroad. If a country needs to balance their current account and can't attract FDI, they have to borrow money, leading to a tax burden on future generations. Now, there are a few circumstances when running a trade deficit isn't actually that bad. So, firstly, if a country is attracting FDI, then theoretically there's no problem with running a trade deficit. Attracting FDI is a positive on the financial and capital account, but a negative on the current account. Secondly, economic growth. So if a country is importing a high volume of goods and services, it is likely to be because the country is experiencing economic growth. Therefore, the deficit is a result of the country's economic strength, and so it can be argued it's not that bad. And finally, investment. If the deficit is a result of importing raw materials that will be invested for future growth, then arguably it is not a problem. So overall, you need to look at what is the cause of this trade deficit, and from there you can conclude whether it's good or bad. Now, let's look at how we solve a trade deficit. So, one of the ways that we could solve a trade deficit is by devaluing the domestic currency. So, a possible cause of a current account deficit could be that import expenditure is greater than export revenue, and this can be solved by a devaluation of the domestic currency. A currency can be devalued by selling the domestic currency on the market and/or through lowering interest rates. And this will leave the domestic price of exports the same, but make them cheaper in other countries. In theory, this should make more people buy our exports and thus solve the current account deficit. But devaluation does have some issues. Firstly, the current account is likely to get worse before it gets better, due to the J-curve effect. Secondly, devaluation of the domestic currency is likely to lead to cost-push inflation, due to imports becoming more expensive. Some economists argue that the benefits of devaluation is eroded through inflation. And finally, exporters might choose to increase their prices abroad to maximize profitability rather than allow the price to fall and help the current account deficit. Now, another way of solving a trade deficit is by reducing AD. If the government reduces AD in the economy, this could be by increasing taxes or reducing government spending, individuals have less money to spend, so will buy less imports, solving the current account deficit. This has the additional benefit of reducing inflationary pressure and reducing damage to the environment. But it does come at the cost of a fall in employment and a reduction in standard of living. Lastly, a current account deficit can be solved through protectionism. And this is the process of increasing tariffs or other protectionist measures which should reduce import expenditure and improve the balance of payments. This also has the added benefit of forcing people to buy domestic products and therefore boost the domestic economy. However, other countries could retaliate and put tariffs on the UK, leading to reduced export revenue. And it is also likely that the domestic consumers may face higher prices due to less competition from abroad, adding to cost-push inflation. That's everything you need to know about balance of payments. Thanks for listening.